Hello, everybody. Thanks for joining us. So, today we're here to talk about our newest acquisition, the flats at Fishers Marketplace in Fishers, Indiana. I'm joined with Tony Landa, Chief Investment Officer. So, before we get started, let's take care of just a little bit of housekeeping. So, this is the cautionary note. Feel free to pause this and read through it. The long and the short is, please don't make any hasty decisions. We're looking for long-term investment partners. And so talk to your trusted advisors, your investment advisor, whoever it is you talk to about your investments. And by the way, keep in mind, we do work with investment advisors. This product is on the Charles Schwab platform. Happy to chat about that as well. So, Tony, go ahead and introduce yourself before we get started.
Sure. My name is Tony Landa, Chief Investment Officer for BAM. Been in real estate since I was a teenager. So for more than 30 years now, I've been in real estate. I consider myself a one-trick pony, if that makes sense. Been fortunate to work for some really good firms, institutional capital, private equity, family office. Have held a number of important roles from asset management to acquisitions to joint venture development and portfolio management. So I've been very fortunate in that regard.
So, and I'm Ben Cotton. For those that have not met me, I'm the Director, Vice President of Investor Relations. I've been in business development pretty much my whole life. Last 6-7 years, I've been in private equity, specifically multifamily, raising over $650 million for multifamily projects all over the United States, and just really happy to be part of BAM and what we're doing here. So let's jump into this. So for those that don't know about BAM Capital, we've been in business around 15 years, done over $1 billion in multifamily transactions. That's like 6,000 units, over 185, right around $185 million returned to investors so far. We are owner operators of multifamily apartments, the kind of places that honestly, if you move to Zionsville or Noblesville, these are suburbs of Indianapolis, or Rogers or Bentonville or Des Moines, and you wanted to live in a really nice place in a great area with good schools, you'd live in one of our places. And we operate everything ourselves. We have over 120 employees. When an AC unit breaks, we're the group that fixes. We don't call people to do that. So that's BAM Capital. Always happy to talk more about it. You can reach out to myself or Catherine or Tony, and we can really give you the spiel on what it is BAM Capital does. So the flats at Fishers Marketplace, the third asset in Fund 4, Fishers, Indiana, 2015 vintage, A property, A location, 306 units. Tell us about the property. Tell us about our strategy. Tell us about the location. Help us understand it.
Yeah, you see the smile on my face because I'm so excited for this asset. First of all, this was an off-market deal. It was brought to us, owned by an out-of-state owner who uses a third-party operator. And so with this particular asset, we currently own and operate 7 to 8 assets, roughly 1,500 units in the Indianapolis MSA. So this is our backyard, and we're very comfortable with owning and operating these type of assets. So first off, value add. We think we can achieve significant economies of scale with the other assets that we own and operate. For example, we have strong conviction that we can trim operating costs by as much as $1,000 a unit. We'll multiply that times 306. That's $306,000 in NOI growth. And so that's big. We look at first things that we can control as opposed to things that are outside of our control. Secondly, a key differentiator for this asset, it contains the largest floor plans in the market that combined with the lowest rents in the market by $175 a unit. Again, that's considerable NOI growth, and we're creating substantial value just by walking through the door. A key statistic that we also look at is called wallet share. So in Hamilton County, it's only 18%. Well, what does that mean? It means that if I'm earning $1,000 a month, I'm spending $180 a month on rent. As opposed to other cities like a Chicago or an Austin, that wallet share is closer to 40%. So if I'm earning $1,000 a month in those cities, I'm paying rent closer to $400. So this is a very telling statistic of the affordability in Fishers and Hamilton County.
Now, it sounds great. So you've got opportunities for cost savings, you got opportunity for organic rent growth, and you got wallet share at 18% net opportunity over the next 24, 36 months to significantly 25-50% increase the NOI of this property. That's exactly what we look for.
Absolutely. And the location is an absolutely killer location. You're in the heart of Fishers. The asset is highly visible. You have easy accessibility to the major economic drivers of the suburbs of Indianapolis. And we have a slide dedicated just about the job growth in the jobs in this county. And so having those things, and not only that, you're in an exceptional school district. The Unimix here caters to families, lowers your turnover costs because they're not typically going to pick up and move too often as a young professional renting a one bedroom. So again, exceptional location, everything that we look for when acquiring an asset.
Hey, Tony, let's talk about the asset, some of the amenities, that sort of stuff.
Yeah, absolutely. Absolutely happy to. So I consider this asset institutional quality. And one thing you won't see on this slide deck, it was developed by a local developer who happens to be a national and prominent developer of luxury apartment communities. So they specialized in developing this asset class. So you're getting a trophy asset with the flats at Fishers Marketplace. Developed in 2015. And when I say institutional quality, recently built, what I also mean about that is that this asset is extremely liquid. It's going to appeal to a large buyer pool when we go to sell this asset. And so when I say large buyer pool, it's going to attract institutional capital, private equity, family office, and private developers. That's one of the reasons why we like institutional quality asset is because it's liquid. And because of this developer specializes in this specific product type, you have the best floor plans in the market, more 2s and 3s than 1s, which is good because, like I said, it caters to families. And it has the premier amenities in the market, best in class amenities relative to the competition. And not only is this an absolutely remarkable asset, trophy core asset, it's situated in the heart of Fishers, like I mentioned, and it's surrounded by outstanding demographics with explosive job and population growth. For example, surrounding the site within a 3-mile radius, the population growth grew by 191% since 2010. The demographics, the household incomes, the average home value are some of the highest in all of Indianapolis. And the projected job growth, what's happened in the past is remarkable, but going forward is supposed to grow by another 52.4% in the coming years compared to the national average of 30%. So all positive signs about this site and the location.
Now, I drove this myself. It's amazing because it's both walkable and drivable. It's convenient to the highway. It's convenient to everything you could ever want to get to, and it's also walkable. In the parking lot is all the shopping you could ever want. It really is an awesome. I would live, like I said, I would live there tomorrow.
Absolutely.
So let's get into the financial overview. Let's talk about interest rates, that sort of thing. Talk to us about that, Tony.
We get this question a lot, right, Ben? Interest rates, what's going on, especially what the Fed did yesterday by hiking rates another 25 basis points. So we don't like to get out over our skis with leverage. And when I'm saying that, it's like this particular asset, we're only taking a loan to value of 65%. And that's healthy relative to the industry standard. Most people are trying to take out 70, 75%, and they go higher if they don't need to. But we want to keep it right between 60 and 65%. It's floating rate debt. The spread over SOFR is 275 basis points. And some people are going to ask, why wouldn't you just fix this? Well, there's such a strong value add component here through operating cost reductions, ancillary income growth, and organic rent growth that we want the flexibility. We want prepayment flexibility. So at the end of year 3, if we think we can execute our business plan, we can get out of this loan for 1% of the loan amount. That is nothing compared to if you locked rate with somebody like a Freddie or Fannie, you're going to have something called defeasance or yield maintenance. And that could be a significant cost. So we view paying the spread over SOFR, having the prepayment flexibility, will pay off in the end. So going forward, and people also ask, how do we protect ourselves? So
Yeah.
we're putting together we have an interest reserve that's going to be held with Merchants Capital. They're our primary lender. They've been our primary lender. We've done over 20 deals with them. Great relationship. So we're posting $535,000 in an interest rate reserve to mitigate the risk of rising interest rates. We're also putting together initial rate cap escrow of $720,000. So in year 2, if we get into a situation, we'll have that money to buy an interest rate cap. The good thing about this product is that if we don't use it, it comes back to BAM Capital and its investors. In the past, we had to buy a rate cap. It was sunk money. It was just, you weren't getting it back regardless of where rates are. This product is unique. It's unique to us. And quite like I said, it comes back to us if we don't use it. So $1.3 million will be held with Merchants Capital in one of their accounts, earning 4 or 5% money. Term 7 years, 3 years IO, and then it converts to amortization and principal after 3 years on a 30-year amortization. And so with that debt in mind and the equity we're putting up, we're projecting a net IRR to the fund of 16%. So I get a lot of questions. What is an IRR? Well, it's an internal rate of return. It's your overall return on the investment with a time value of money concept tied to it. So really simply put, the IRR is 3 things. It's cash flow during the holding period, it's a return of equity, and it's return on equity. That's it. Equity multiple is pretty easy to explain as well. Ben, if you give me $100, I'm going to give you at the end of when we go to sell, I'm going to give you your $100 back, and then I'm going to give you another 100, whether it's through cash flow or profits. And so I'm doubling your money with this investment.
Yeah, no, Tony, that's a lot to unpack. So I'm just gonna put a couple of things out, put a fine point on it maybe. So number one, from a protection standpoint, if rates go up, we've reserved money to pay for that. In the past, we would have had to pay essentially a company for a cap or a swap or something like that. And that money's essentially gone. So we've got it if we need it, so we can sleep well at night. We're putting 35% down, where in the past, maybe we would have put 25 or 30. So we're putting more money down and we're reserving cash. The idea being we're in this for the long haul. And conservatively, we think in this deal to the fund, we should double investors' money in a 4 to 5 year period.
Correct. Said well, Ben.
Anything else to point out on that?
I don't think so. I think we really uncovered it. Like I said, yeah, I think we covered it all.
Okay. So let's get into Fishers, Indiana. So for those folks who, are California investors, our New York investors, our Florida investors, the folks that don't know, Fishers, Indiana, let's talk about Fishers. Could give us an overview on Fishers, if you would.
Yeah, some of the bullet points on this slide were already covered. So I don't want to be redundant, but 2 things that really stick out on this slide are, number one is Indianapolis in the Midwest. I call it the last bastion of affordability for renters. And so it has taken over. It's not, Indianapolis is now one of the top 5 markets for rent growth. In fact, it's number 3, and it was at 6 or 7%. Number 2, Ben, is your backyard, Cincinnati. Yep. So for the first time in a long time, I think there were 6 or 7 Midwestern markets that were in top 10 for rent growth. And so institutions have taken notice as well. Before, the Midwest was kind of, red flag. Nobody wanted to invest there. Well, that's changed. And so the market has become extremely liquid. Like I said, the rent growth has been exceptional, and institutions and private equity are taking notice. The other thing that stands out on this slide is one of the items that we look for when going into any market. And so in Indianapolis, for example, the supply-demand imbalance is exceptionally low. So at the end of 2022, Yardi Matrix put out a report. Top 5 markets for rent growth, Indianapolis. It was double digits. And what we look for in every one of these markets are deliveries and supply. That's always an issue. That's an issue in other markets, that aren't Midwestern related. You go to the Sun Belt, you go to the Southwestern markets, you're going to see a ton of supply, and some markets are quite frankly oversupplied. Indianapolis, not that way. In 2022, the total deliveries relative to the total inventory was only 1.3%. So when you couple that job growth with the supply demand balance, it's a recipe for success.
Yeah, and look, literally an article just since last week in the Wall Street Journal talking about Indianapolis and its affordability and its attractiveness. You know, as somebody who lives in the Midwest, it's a great place that's still affordable to raise a family and to live and to work. And I can't say enough great things about Indianapolis, Cincinnati, Des Moines, Bentonville. These towns, they're great towns. Quite frankly, I own multifamily in. This slide is a little deeper into the market overview. Let's talk about, well, first I want to point out, just so again, for the folks that aren't in the Indianapolis area, realize, we've got 2 properties that are already in this area. They're all within essentially a 15-minute drive from one another. So we have a lot of shared services that we can use. But then let's talk about jobs, right? It's population growth and jobs. Tony, maybe you can tell us a little bit about the employment in the area.
Well, just to add on what you said, so of the 7 or 8 assets that we own in Indianapolis, 32 unions just northeast of Flats at Fishers, and Hamilton Station is as well. So by having those sister assets located nearby gives us the ability to share resources and to really be efficient with our operating costs. And so that's a big thing here. But this slide is really to show you how diverse the Indianapolis economy really is. You have financial services, you have insurance, you have building materials, you have travel, leisure, you have automotive, and healthcare is a big component here in this market.
So Tony, let's get into some of the statistics in the market for jobs and job growth, that sort of thing.
Yeah, we felt it was important to dedicate a slide to job growth and what's occurred here in Hamilton County. Total labor force of 196,000 people. Jobs have increased 2.5% over the past year. That's been very steady over the last 10, 20, 25 years. Very steady job growth. Future job growth, like I mentioned in the previous slide, is projected to be 52.4%, which far exceeds the national average. And I think this is a very telling statistic. Healthcare jobs, 22,000 healthcare jobs. Back in the day with a former employer, we had a large multifamily portfolio around the country. And some of our best performing assets were the assets that were located near major healthcare. Why? Because they're safe, they're not going anywhere, and they're extremely stable. And so in having these jobs in Indianapolis and buying assets that are affordable for these healthcare workers, it's critical. And you also see here on the far right, you'll see unemployment. Obviously, it ticked up during the dot-com bubble, during the great financial crisis, and a little bit to COVID. But right now, it stands Hamilton County at 3.1%, which is extremely low relative to the national average.
Yeah. Couple of things just to remind everybody, our non-negotiables. It's got to be in an area where there's population growth. It's got to be in an area where there's job growth. And there's got to be good school systems. And it checks all 3 of those boxes. I mean, full check, if you will.
And the supply-demand imbalance is absolutely critical.
Tony, let's get into a couple of questions that we've gotten from investors. One question that comes up is, hey, in the last 2-3 years, you haven't purchased any assets in Indianapolis, and now you purchased, 32 Union and now the Flats. What's going on? Why have we been successful? Because I know it's not for lack of looking. What's made us successful, or what's allowed us to be successful in buying now 2 assets in Indianapolis in the span of like 6 months?
Simply put, rising interest rates, to be quite honest. So during these times, I've worked for institutional capital and private equity. During these times when there's kind of uncertainty in the economy, there's rising interest rates, what the decisions are going to say, there's going to be price discovery. The asset valuations might reset, no guarantee, but they want to wait and see what happens when the dust settles. And so I've worked through 2 down cycles for real estate. One was the dot-com bubble in 2000, and the other one was the great financial crisis. And at the time, I was working for Institutional Capital, and our pencils were down. Well, looking back on my career, our pencils should have been up. And so right now for BAM Capital, our pencils are up. Institutional Capital is on the sideline. Most of it is. Private equity is out on the sideline. And it's really turning up some really good opportunities for BAM Capital.
Yep. No, as an operator, we control a lot more of our destiny than our competitors. What I'll call the financial engineers. And so because they have to put more money down, because debt's more expensive, they can't make the numbers work, where we can go, look, on a cost side, we can take $1,000 per unit per year out. That gives us a lot of confidence to say, hey, look, we're buying at a, 5.25, 5.5 cap. But when we operate it, it looks more like a 7 cap, right?
No, absolutely. Well, yeah, absolutely. So if I could put some numbers behind it, let's say we're acquiring an asset for $10 million, right? We're going to put leverage on it, let's say 7 million. So the initial equity slug is going to be 3 million. NOI, let's say it's a 5 cap, $500,000 on a $10 million purchase. Well, if you look at today's interest rates, 5.5 to 6, as high as 8 in some cases, that doesn't make a whole lot of sense, right? Because it's what we call in the industry negative leverage or negative ARB. So, but if this asset was a coupon clipper, I would agree with that. But this asset's not a coupon clipper. It's got significant value add. So we're looking to take that $500,000 in NOI to $750,000 in NOI in a 3 to 4 year time frame. Well, if we take it to 750, we sell between a 5 and a 5 and a half, that's going to be $14 million. Once I pay back my debt of $7 million, I'm left with $7 million on my $3 million initial equity investment. Well, that's a 2.3 multiple. I mean, then that's on the back end. And so that's going to give you your high teens IRR, and it's going to double your money, regardless of really where rates are. So Ben, let me ask you a question. I'm an investor. I really like this asset. I like the location. I like the business plan. I like the sponsor. How do I invest?
No, listen, great question. So this is the third asset in Fund 4. The August deployment, that's essentially already filled up. But good news is we should be doing another deployment on September 1. So if you're an investor, you like this, you have some time, but the best way is you can go to our website. You can reach out to Catherine. Her information is on the screen, myself or anybody on the team. We're happy to explain to everyone or anyone that's interested how Fund 4 works and how you can be part of it. Thanks so much for joining us.
Thank you. And thank you, Ben.
Yeah, listen, have a great day.
You too.